All opinions expressed by the Kendall Report participants are solely their opinions and do not reflect the opinions of VPM Partners, and may have been previously disseminated by them on television, radio, internet, or another medium. You should not treat any opinion expressed on this broadcast as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of an opinion. Such opinions are based upon information that the Kendall Report participants and Robert Kendall consider reliable, but VPM Partners does not warrant its competence or its accuracy, or should it be relied upon such. The Kendall Report participants, VPM Partners officers, directors, employees, contractors, guests, are not under any obligation to update or correct any information on this broadcast. The Kendall Report participants are professional traders or investment advisor representatives who may be actively involved in securities herein on behalf of themselves, their companies, and their clients. Also, the opinions expressed by the Kendall Report participants may be short-term in nature and subject to change without notice. No part of the Kendall Report participants' compensation from VPM Partners is related to a specific opinion they express. Past performance is not indicative of future results. Kendall Report participants and VPM Partners do not guarantee any specific outcome or profit. You should be aware of the real risk of loss and following any strategy or investment discussed on this broadcast. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned in this broadcast may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs and is not intended as recommendations appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this broadcast. Before acting on the information on this website, you should consider whether it is suitable for your particular circumstances and strongly consider seeking personalized advice. Nothing contained in the Kendall Report broadcast or VPM Partners on its website or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by any particular security, other investment product, transaction, or investment. Copyright 2017 VPM Partners and the Kendall Report, all rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic media in whole or in part is prohibited under penalty of law.
Now, for your host, Bob Kendall.
Welcome, everyone, to the Kendall Report for December 3rd, 2018. Of course, we have an interrupted week this week because of the death of President Bush, and so we'll be off on Wednesday. So it changes a little bit of the, I guess, the process that will go this week in trading. Lots going on. You follow me on Twitter on Fridays. It might be a little dangerous to anticipate. There was a lot of short covering on Friday, pushing the market up at the high end. Of course, we saw a huge rally last week in the S&P and across the board. And so what we're experiencing is that X wave that I've been talking about. We'll go through it in a little bit here, but the actual pattern is unfolding is pretty much as expected. And when I go through the details of the technicals, you'll see we rallied right up into a key resistance. And if last night after I was shutting down, I did short the futures at 2807.50, and I'm still short those things. I wouldn't be surprised to see the market turn negative because think about it. The fact that they delayed the tariffs, was that really bullish? I don't think so. Nothing's changed. They're still negotiating. There's no deal. There's no nothing. So, it was kind of interesting the way how emotional the markets are right now. And you see these huge bids come in. Last night it was interesting. I was just sitting there going, this is not real. This is not going to last. So we'll see. But the bottom line is we won't get increases in the tariff costs in January like we were expecting. The Fed's still going to raise rates. Everything's back to exactly what it was before last Monday and before Powell made some dovish, I guess perceived to be dovish comments that we were just below neutral. And I've been saying for maybe 2 or 3 years, you've been watching the show, that a neutral rate is somewhere between 2.5 and 275. Well, we're going to be there. So yeah, he's right. But what does that mean for going forward? Does that mean the Fed's going to have to continue to raise rates or not? And I believe they will. And we'll see as we come into the end of the week. We'll get employment numbers and all that. So we'll see what unfolds this week. Like I said, it's a bit disrupted, and we'll see, I guess, a continuation of this sideways pattern I've been talking about. Well, welcome to December, the final 4 weeks. We're going to see this market just kind of chop around. I suspect I changed the trading range criteria and commentary from about 26.77 to 28.16, extreme 28.28. Very good chance if we do end up closing lower today, we're not going to get above 28.16. That actually is a pretty important number from a technical viewpoint anyway. So we'll see how these things unfold. As far as everything else goes, the G20 went as expected. It's a typical rah-rah kind of thing where nothing really gets changed. They acknowledge the new, I guess we'll call it, I forget what they call it now, instead of NAFTA, but the new deal with Canada and Mexico. So all that's happening, nothing's changed. So let's go ahead and dig into into as far as, matter of fact, let's just review one thing before I move forward here. Let's go ahead to full screen here, and let's take a look at what is coming out this week. Of course, I guess with the markets closed, I suspect, this says Powell's testimony has been canceled. Everything, I suspect we'll still have the ADP report out. So a lot of activity will be compiled into tomorrow afternoon's close, people settling up their books prior to the markets being closed on Wednesday. And then on Thursday, we'll have to resume, and there may be a little extra volatility with this blip in the middle of the week. But as we get toward the end of the week, obviously we'll get to the unemployment expected to be unchanged. Let me just bring that up on screen here just real quick. So we're looking at 190,000 new jobs again, unemployment to stay unchanged. We're looking at the payroll about 183. Anyway, all this stuff is pretty much static as it has been. So there's not likely to be any surprises as we come into this stuff. So let's go ahead and go over to the technicals and start talking about some of this. And you'll see, and I'll map this out a little bit. There's a couple things. I'll bring up the graphic that I have put in commentary for the last several days. It's been pretty relevant as far as nothing's really changed in the pattern. I need to update that chart. So we'll use that as a reference point here in just a minute. But the pattern is interesting. Right now we're trading at 27.77. The low's been 27.73. The number on the downside to watch out for is 27.68. I mentioned that in commentary. And if that's taken out, then we're probably going to go back to unchanged or maybe even close negative on the day. The Dow Jones was up 450, now up 182. NASDAQ is up 7.7. And, I did manage to get off a pretty decent triple short off of the open. Not a lot of money in it yet, but I think we'll see these markets continue to pull back. We'll talk about a couple more things here that I think is relevant here as this pattern unfolds. You'll see over here on the chart where my cursor is it's showing us that there's a number of downside Fibonacci projections that keep coming up and then they get negated. But these targets are still valid, and I talked extensively about this 21-month moving average being the floor for the market right now. That's 20 around, we'll bring that up here in a second, but that's 26.65, 70 range. It's changing since the markets are now open. We'll take a look at it. But this pattern is pretty typical, and I expect to see what's called a double zigzag, which is, let me just see if I can bring that up on screen here real quick here. So here's the chart here, and this double zigzag where we go up, and you can see the ranges that I had projected here in the green letters. I think you can see that, but it's 27.68 to 28.16 is kind of the target range for this move up, and then we're going to go back down and go back toward this 26.70, maybe reprint 2600, even get down to 02 level that we printed a few weeks back. But the bottom line is this thing is going to chop sideways, and as we come into 2019, depending on where we are in that pattern next few weeks, we're going to see the markets resume this downtrend that we started a number of months ago when we printed the 2940 highs. There's a number of things that are to be considered here in this pattern. I have some other charts I'll bring up here later in the broadcast, but this is definitely showing us that this is a daily graph, so this is showing the short-term noise. We'll go back to TradeStation here and take a look and go over to the intermediate chart. What you'll see here is a much different pattern. We did manage this pattern that's emerged. We did manage to get some Fibonacci projections to show up on the intermediate chart, but it's going to take a move below 2630 to negate it. So this is going to be on the books for a while. I don't think it's going to be reached. If you look at the PPMs over here, we're minus 0.49 on PPM 1. On PPM 2, we're minus 0.04, basically flat, slightly up on PPM 3.08 positive. And if I go up here and take a look at in fact, I'm going to switch over from this chart over to this one. This is a little easier to see on your screen. Let me just do that real quick. So this pattern that we're seeing here is basically you get this strong downtrend on the 10-week moving average. Now we're trading above it. That's going to act as, with a minus 0.49, that's going to act as almost a magnet to pull the markets back down below that level, which is 27.49. So that's 30 handles lower. I suspect that by the end of the week we'll probably be there. We could even be there yet today. Because there's really, like I said in the opening commentary, nothing has changed from the standpoint of what's going on with the market. Fundamentally, everything's exactly like it was. The fact that they suspended the tariffs doesn't really mean anything. Nothing's changed. So we're still at the same fundamental point. Everything is like it is. We still have issues with lots of things going on with the FANGs and all that stuff. So, like I said, we're also into a phase where we're going to be winding down the year end. There's going to be a lot of window dressing, other elements, and cross currents that are going to come into market as we come into the final couple weeks. And I expect that's what's going to keep us in this sideways trading range I'm talking about. I don't see, we could actually, depending on how this pattern unfolds, we could see the first week, or maybe 2 weeks of January actually be positive before we resume the downside. The key pivot number on this chart is at 2816, and there is some leeway if we got above 2816, 2828, and then 2856.68 is an absolute extreme. So as we look at this stuff, you can see that the PPMs are still well under their first and second derivatives, and anything under minus 0.25 on this PPM 1 here does suggest or indicate that we are in a downtrend. So I don't see any of this stuff actually inverting or anything else going on as far as these patterns go. We're going to be pretty static as far as that goes. If we go over and look at the long term in the monthly graph here, you'll see that it's interesting because I saw this on the futures last night. As we went from a negative PPM 1, it literally flopped around. It went from a negative 0.23 to a plus 0.23. So and you can see what it looks like on the chart here. If you look at the 10-month moving average, it's just flat. And this is really typical. I've spent a fair amount of time over the past several months talking about this pattern. It's a very similar pattern when we came into 2008 2007 and 8, as we formed that top there, we're seeing the same thing here where the markets get sandwiched pretty much between the 10-month moving average and the 21-month moving average, because the 21-month is still moving up. This could last possibly through the month of January, where we maintain that 21-month moving average is going to be the floor of the market. So let's take a look and see what the value is here. So that value is 2652. And when it was calculating earlier, it was in the 60s, but since we have moved back here a fair amount off of the highs, this has caused this value to drop a little bit. So somewhere around 2760, and in fact, I'm going to back up for just a second here, is what you're going to see, and I didn't discuss this a minute ago, but I'm going to go back to daily. If you look at the 200-day moving average is 2762. I just talked about the 10-month moving average being 27, or the 21-month moving average 2761. So everything is, once again, that cluster still exists there. And I suspect we will go back below that. And even the PPM, the VPM PPM 200 has inverted and is now showing a positive. It is actually moving up. It was negative as well. So just with this little bump in prices that we're seeing here today, 0.69 advance, we're seeing that is absolutely turned around some of the momentum on the PPMs, which really is typical, I think, here as far as the patterns go and this sideways configuration that I'm talking about. So as we look at the progression going from the daily, weekly, and monthly graphs, you can see they're all telling the same basic story, right? So I'm going to flip back to the long-term chart here for just a second. As we look at this, what we're going to see, like I said, this, I'm going to draw a couple areas here where we can take a look at and focus in on some of this stuff. Let me go full screen here. So the areas that I'm talking about right here, this is 2008 where I'm putting these arrows, and you can see that we remained sandwiched in this little zone right here before the market ultimately went down. I suspect we're going to do the same thing over here where we're going to get sandwiched in a range, and then the 21-month moving average, which currently has this 0.76 upward momentum, which, as I've said, and those of you who watch the show a long time know, anything over 0.25 is still an uptrend. So there's a very small probability for the markets to go below that. And the fact that all of a sudden we're printing a 0.24 on PPM1 suggests that we may be able to stay above that average, but I think we'll see that fade as the month goes through and this sideways zigzag, what's called a ABC X ABC pattern unfolds for the month of December. I really don't see any reason for us to break out of that, and certainly a lot of market participants thought that this event over the weekend was the reason to take the market higher. You can see there's a fair amount of resistance against that, and we're likely to see, the machines couldn't even take over this morning and push this market up. There was a lot of selling around that 2,800. And in fact, the extreme number was 2799.70, and we just hardly went over that on the Fibonacci projections for today. But you can see here on these patterns, I'm expecting that we're going to stay in this range, most likely below 28.28 or 28.16, 28.28 is going to be the top end of the range, and on the downside is going to be that 26.70 is going to be extreme. And if we go back real quick over to this pattern that I was discussing on this chart here real quick, this one here, you'll see that this thing is just going to be real choppy. This will easily carry us into the end of the year. And like I said, possibly into the first week or two, depending on what phase we end up in. Ultimately, I'm counting this as the top of a wave 2, which tells me the next move down will be toward the 25, 2485 levels. And if we go back and take a look at a couple things here, let me just see if I can. I just want to see. I think this. I want to go to this chart here, and this is a chart that I discussed on my special broadcast I did the other day on the longer term aspects and of the markets. Is that what we're seeing here? Is that we're going to move somewhere. We may have already did the bottom at the 2630. We printed 2603, and then we got 2630. Now we went all the way up to 2800 again. As we work this pattern, the next level down, as I have here on zone 1, is going to be that 2558 down to 2483. That could be the January lows. From there, we probably see a little bounce again. This chart is just illustrating the levels. It's not necessarily how the configuration is going to unfold. As I see more of the market, I will actually map out the best I can expectations. And those of you who follow me a long time, you know I'm a bar counter, so I'm always looking for some type of configuration, 3-3-5s, all kinds of, I've got about 15 different variations. So I'll be mapping that out as we see these markets unfold. And there's not enough to tell of the picture to map out this next level. But the bottom line is we are going to see this move down. Like I said, probably 20, we could go as low as that 2483 level. We bounce from there, and then I discussed this in that special report. If you haven't watched it, there's an edited version. It's 26 minutes. That's on the Kendall Report YouTube channel you can watch. And this lays out these patterns, and it's highly likely that we will see both phase 2 and 3 hit this year, which tells us that we're going to go at least to 2370 to 2325. Then the next level is all the way down 2100 down to 2800. And if you watch that report, I won't go through it again, but I would definitely watch that report, and you'll see some more intricate parts and expectations from that presentation. Be much better to watch that. It's well thought out and described well. So let's go back to TradeStation live charts here. As I was saying here, the PPMs are, even though they are positive enough to show that there is an uptrend in place, even though that's the case, we're really looking at all of these indicators. I shouldn't say the first two primary is that it's below their first and second derivatives. On PPM 3, today we've kind of spiked up. We're back at 0.85. If you've been watching this show for a while, we got down to 0.59 a couple of weeks ago when the markets were at lower levels. We're back at 0.85, and 0.70 has been the magic number there. So everything is kind of stabilized again, which plays into what I've been talking about is a sideways movement. I don't see any major moves up, even though we did see some traction on the database, and I'll go through here in just a minute. We'll talk about the VPM database and what it looks like, and especially on a short-term basis, we've seen some decent traction while this market's it has been rallying over the last couple of weeks, and you would expect that. So let's go ahead and let's go over there and take a look at a couple things, and we'll go over to VPM 2.0 on the dashboard here. And we'll see a couple things. And one of the things you see is we're now up to 13.42%. We got down to only 9.6% of our symbols long out of 17,696. We only have 2375 long right now, so 13.42. We've got two sectors that are showing up as long. In the groups, we have about 17%. So everything's, as I've said for a while, VPM database is actually set up for a catastrophic move, and I've not seen this thing move down as fast as what we've seen in the past. Now we did get a healthcare buy here. I'll pop that on the screen here, and healthcare is trying to come back in. Let me see if I can make this a bit bigger. So you can see a little bit here that, we did break back above, and we saw a lot of reversals last week. Last week was a pretty substantial week. Is it enough to turn the markets around? It doesn't appear so, even though we did see an uptick here in the healthcare, and it's likely to continue to stay positive here as we go forward. So as we look at, we'll go over to the daily, and this is what I wanted to show you. And we have seen, while this thing there's actually two things I'm going to show you. I'm going to cover a bit of the VPM universe chart, which encompasses quite a few of the the equity side is the 17,696 symbols. So it's an interesting way to look at the markets because it's an unweighted view of the markets. It's an equal weighted, and it has quite a few stocks. I think there's over 7,000 symbols that are representative in that model. But as we look here, you can see this model hasn't even come close. This ABC pattern is much more defined here. But what we're looking at here is the daily has moved all the way up to 39.11% bullish. And this is on a short-term basis. You would expect we had a couple days last week on the rally that we saw substantial moves on the upside. And the reason why the database is going to react on a short-term basis, on intermediate, it's not really reacting at all. And on PortfolioXpert, we actually have the secular trades, but we don't have a view right now, and it's something I've got on a development list to have kind of a secular view of the models from the standpoint of what's trending and what's not. But as we look at this on a daily basis, we also see there's 5 of the sectors have turned long, 41% there, 43% of the groups, and 39% of the symbols are actually long on a short-term basis. But intermediate, as we were just talking about, we're down in the teens, 13% on the overall database. So let's go back over here to the weekly, and let me bring this up. I think this you'll see what I'm talking about here. I'm going to make this a bit bigger so you can see it, hopefully. That is not working. So right here is about as big as I'm going to get it. But you can see on the breakdown of this universe chart, we really have rallied back to the moving averages. All the PPMs and everything are incredibly negative. It's much different look and feel than when you look at the S&P 500. All of us spend a lot of time looking at S&P 500, and this gives a much different perspective. Not only that, the VPM universe chart never made a new high when the S&P made a new high. So it's very likely, I'm going to attempt to draw on this page here. We have a unique view of the world here, but this is a 2016 rally. This is a 17 rally. And what we're looking at here is a much different pattern, since right here, if you can see everything I'm drawing on here with this down arrow, the VPM database did not make a new high, and we saw this collapse. So this, and then down below here, you can see the PPMs are well below their first, second derivatives. They're all very highly negative, and that there's really not much of a chance for the overall database to actually turn and get bullish here. And this is important. And I've talked a fair amount about this over the years. Is I have a very unique view because I'm looking at 17,600 and change symbols that are all representing the techniques and the trend following methodologies that I built into the VPM WaveTech models. And so the bottom line is we're looking at the probabilities of this market turnaround, making new highs on a broad scale is just about nil. So as I talked about in that special broadcast I did last week, I really think what we're looking at here is a major bear market on the way. It's already begun. We're going to see some stability. I always talk a lot, if you turn on CNBC, they have the yay days, that when the markets are up, they're celebrating. When the markets are down, it's very somber, very serious. And then everybody's kind of walking around the set high-fiving. And of course, in New York Stock Exchange, it's just become a glorified TV set. There's really not much going on there anymore. But the bottom line is that what we're seeing across the board on all of this stuff is that there is not enough to push this market over the hump. And what's going to happen as we go forward, I believe there's going to be more headwinds as, this China deal is not going to come down. I don't think it's going to come down as well as market participants would have liked, like the big celebration that we saw this morning. That was a perfect place to fade. When I first saw the open yesterday at 4 o'clock Mountain Time, when the S&P futures opened, certainly after I put out a tweet that you definitely want to fade this thing. And so far, if you did that, and I was looking for 20 handles, so you've got that and then some. And the whole pattern that's unfolding is just really, really negative on a intermediate and longer term viewpoint. This is the tipping point of the market, and I said in my special broadcast that I did last Wednesday is that, I've called Wolf several times. It looked like we had a couple of tops, possibly, in 2016 when we started. Of course, in the first quarter, things turn around. And if you know what I do, I am process driven, process turnaround. We got really bullish. The database came screaming back, and we got long in, first quarter of 2016 and stayed long until, into January of this year. In February, we lightened up, and then we got long a bit again, not as long as before. And now here we are again in this kind of negative configuration. So let's take a look at real quick on some of the other things that are here I think are important. I want to go to the home page, and this is the view of the. Let me make this big screen so you can see everything. So this is the histogram of the VPM database, and what you're going to see here is that when we made that new high, we had a much lower high. We only got about 52% long. When coming into January, we were about 64, 66% long, and you can see the midpoint way back, in 2016 and 2017, we got into the 70 percentile bullish range. Now, our database never gets 100%, although I did see it swing in 2008 when we came out of that in early 2009. We went from a minus 6% long in 2008 all the way to 96%. Basically, everything kicked in as a trend at some phase in 2009, and we haven't seen those kind of numbers since. In fact, normally this 62 to 74% range is about where the database gets. And we did do that. That tends to happen in the middle of the rally, which you can see here. And then each subsequent rally has less and less participation. So especially when I was talking about the 5 waves up that we have in this pattern, we're definitely looking at fewer and fewer stocks participating in the rally, which tells you it's narrowing down and coming to a top. Well, like I said, we're way down. You can't see on this chart the bar's way down. You can see my cursor over here. The bar's way down at 13% right now, and this particular chart doesn't scale as well as it should. But the bottom line is, it's showing you exactly that we've completely collapsed. The database has completely collapsed, and it's went below the previous low. So previous low in 2015, August of 2015 and 16, we were down just below 20%. And now, like I said, we're down to 13, and we were at 9, which was a bit extreme. And so we are seeing some things turn around. We have seen, with the treasuries dropping from where they were down to, back, they went sub 3% for a minute. We've seen some bonds come into play. So let's go ahead, speaking of treasuries here, let's go ahead and go back and let's take a look at some of the other markets here. Let's take a look at treasuries, and we're printing sub 3% right now on, this is monthly, so let me get you to let's go top down like we usually do. So as we look at this, you'll see that it's interesting. I'm actually really surprised that we were able to get down here, and that market participants there's a lot of money's poured back into bonds, and we're printing 2.999. So we're basically at 3% again. I still expect to see this thing bounce back to around 308 to 312 by year end, as this thing should start to stable here. We are coming up close to the 200-day moving average. I'll bring that on screen for you. So that average is 2.95, call it 2.96. So we're pretty close to probably bottoming out here, moving back into those other averages, which are right now 311 to 314, 313 level. And this market should rebound from there, and bonds will stabilize probably right around this level. I can't imagine with the Fed, they're not on hold. They're going to raise rates, and this is flattening out yield curves quite a bit. So speaking of that, let's take a look at some of this stuff, and you see here the 210s are flattening out a little bit, trying to flatten out again, and the 1030s are okay, and this is the 25s, and they remain pretty flat as well. So we don't want to see these charts invert and go into an inverted yield curve, but it doesn't look like they're going to do that. And one of the charts that we should look at here before moving on is right here, where we've got all the moving averages on the same page. You'll see the 30, which is the top line up here, is remaining around 320, and we've seen the orange line is the 10, and then we get the 5-year. You can see these spreads are kind of maintaining a little bit, and we finally have flattened out on the 13-week T-bill at 2.30, and I suspect that's reflecting, that's a little low if we're going to have a 250 Fed funds rate. I'm going to be shocked that if we don't see, as we move toward the Fed meeting in a couple of weeks, that we don't see this thing move back up. As far as having any real effect on the equity markets, there's very little that the equity markets are going to react to any of this stuff. And this is really, I talked a little bit before, some of the stuff that's going on in Europe and Brexit and all that. There's been some money move over here because of those things. It's not all domestic influences that we're seeing in the Treasury market. So, did Powell get dovish? Some people are claiming that, President Trump bullied him. I don't think that's what happened at all. I think what you're really seeing is just a flow of capital, especially around Brexit. There's some other things going on with, Italy and other issues in Europe where there's some protection, some safe haven money being moved into. So let's go and let's talk about a couple other things here, and let's go and take a look at emerging markets, which is absolutely screaming today. And you can see this pattern here. Let me go full screen. The pattern that we're looking at on this is really probably going to move up towards the 43 level, possibly into the 44 level, moving up towards its 200-day moving average. This last trend has been pretty good. We have a portfolio that runs the daily, and we got chopped up on the scene here, and it looks to me that we're going to be in pretty good shape here. Let me just put a strategy up here, and we got a really good buy on here down at 39.56. So that's still in play. This is probably going to end up to be a pretty decent trade. We're up 2.08% today, and we're even seeing some of the activity in Europe actually do pretty good too. And EFA, which is kind of encompassing more of a world index than anything. You can see we had a buy there, but we really don't. The configuration is much different. So we'll take off that strategy for a minute. But the bottom line is that EFA and the emerging markets have responded pretty good. In fact, they've responded better than what we responded here. We're only up about 0.9, where they're up 1.2 and 2.05 on the emerging markets. So as we look at let's take a look at, let's go to the Dow index here, and we'll cover, to finish up the day, we'll go through the Dow, we'll go through crude and gold, and probably we'll come back and just kind of recap everything that's going on in these markets. But the Dow is continuing to be pretty buoyant. I've talked about this a fair amount on a daily graph. Momentum's kind of flattened out here, and we've gotten into a sideways trading range, but the likelihood of this thing continuing higher is still pretty good. I joked about trolling Peter Schiff a little bit, because he's always bearish the Dow, and he's, about 6-8 weeks ago he was telling you that the Dow is going to collapse. Of course, it goes straight up, and so this pattern is unfolding. We're hitting. You've got some pretty good momentum. Plus 0.21 was just below trend level on PPM 1. And PPM 2 and 3 plus 0.14 plus 0.21 is significant enough that gives you an underlying bid in this market, and it's not likely to go away. And then when we go over and look at the long-term graph and the secular trends, you're going to see a much different pattern, in that we're really set up this really broad trading range. And I'm just going to bring up the whiteboard for a minute, and this is probably what the Dow is really doing. I think if we come over here and we just map out, there's a couple aberrations and things that happen. As far as I can see right here, is this range in here, in between these two lines, is where we're likely going to stay. I don't think we get much under probably 92-ish, and we don't get much over 98 right now, even though we're seeing a turnaround in the monthly PPMs, which tells us it's likely to keep an upward pressure on the market. So there's all of these markets, by the way, I need to say this, is that what we're looking at now, this is going to be some of the, if you're a trader, this is going to be one of the easiest trading markets, because you're literally going to play that range. I was fearless putting on those shorts above 2,800 last night, because there was just very little probability that it was going to stay above that level. And I did cover, when we were off screen here, I did cover a little bit of my triple short. Just take that off. I still have the short futures on. And the bottom line is what we're looking at here is all of these markets, the Dow, and we'll go through gold. All the markets I'm talking about are all going to be locked in a range, and they're going to have enough volatility. There's going to be some wonderful trades. What a great way to end 2018 if you're a trader. From the standpoint of looking at trending markets, we're going to, and advisor class clients that I have, you're going to be continuing to stay in cash. You'll see some of it on individual strategies, individual equity strategies will start to maybe pick up a few things and use some of the cash, but the indexing stuff is going to be really bad. And I'm going to look. I saw an article that Vogel, the guy that started the first index fund with Vanguard funds, right? He's talking about how dangerous we're getting in this, and I agree totally. Is that we're really everybody has got the same strategies on, and in fact, we run about 10,000 unique portfolios every day, and it's scary. There's about 12 to 14 different symbols that most people are using. Folks that aren't using and doing individual stocks tend to own all the same things. So when the markets start to really roll over on this next level, and I was talking about the longer term aspects, you're going to see a lot of things go on. And so the whole concept here is all of these markets, whether it's the Dow or gold, and everything is locked in a sideways range. So this should be a nice way to end the year. So let's take a look, and we'll go from the dollar to, let's go over to energy. Let's take a look at crude. Unfortunately, I have this on monthly. This is okay, but you're going to see this big drop off. If you've been watching this show for a while, you'll know what I was talking about here. And I'm just make this full screen and go so you can see this. Is what we're seeing here is this cliff that we fell off of. And this is the nearest futures chart, and that's why it took so long for this thing to come up. Is it was calculating the nearest futures. But the bottom line is we've dropped back into these moving averages. And originally what I talked about, and this is a classic pattern, I'm going to draw this on here, is that when we were back in 2016 and everybody was talking about crude oil going to zero, what I was talking about is that we would rebound back into the moving averages. Let me put this up on screen so you can see what I'm talking about here. And what's possible here is, and this is what I was talking about, where we'd get this pattern unfold and we'd come into the moving averages. Ultimately, all three averages would converge and cross over. And typically the pattern that we have here is this, as you get, this is kind of a simplified, this is an ABC, this is probably an X, and we're going to get another A, B, C, and we're probably going to end up, I don't think we get over 100, but we could get back in the 80s. But it's almost like what I'm talking about here is that this pattern is going to stay in this range I just put in red. And we're gonna remain in that range. We might get up to 80, 85, but this is what you're going to get. And I think we're really close. I started at the long-term analysis, and we'll work our way backwards on this one. We'll start at secular, we'll look at the intermediate, and then the short term. And what you're going to see here is that this pattern is, like I said, there's so many trading opportunities out there, and a lot of these commodities and some of these, even on the ETF markets, there's possibilities for this thing to go to be able to trade this. Sorry, I'm not sure why it always goes back to that screen when I X out of that thing. Anyway, so but this pattern here is going to be there. So let's take a look at the intermediate so you can see. So we look at the weekly. We're going, I guess, top down here. You'll see this big decline here. This just breaks out the finer details of how where crude is at. I think we're going to rally back towards this 10-week moving average, and that number right now is 61.70. It is dropping about $2 per week. So we're probably looking at 58 to 62 on the upside. And so there's a nice trade here in crude setting up. And I'll look at this daily chart here. We'll go there next. And you'll see this pattern. This is going to take about another 5 to 8 days to set up. But there is going to be a pattern. You should move up to around 54, 56. We'll back up. Then we'll be able to make that 56, maybe 58 to 60 run, as we come into these moving averages. And all of this stuff is set up. All the PPMs have turned. So there's a pretty safe trade to probably buy into this range here. And we're probably looking at, let's just bring up a Fibonacci calculation here real quick. But if we look at where we're likely to go here, you know, we're looking at somewhere around between, we'll call it 51.72 and 51.24 is probably going to be the best place to look to buy this thing. And then we should be able to see the move to 56.68 if you're willing to stay that long, but there's going to be a lot of good trades, and it looks like you want to scalp from the long side for at least the next 3 to 5 sessions. So next, let's take a look at gold. And this is going to be the daily graph. I've been talking about this a fair amount. This base that has been building in gold is pretty substantial. And I still think we'll see somewhere around 1260, 1270. This range that we've been locked in for a while is kind of interesting. We're stair-stepping out of this thing. I'll draw in some of the patterns just so you can see what's going on here. So we're going to get it's basically this pattern right here. And I suspect we'll see this thing move up toward this. This is a 200-day moving average. It's at 1275. It's declining a little bit, but that's where 1265, 1270 is going to be the target. And it's interesting that supposedly this big reversal in the markets, in the equity markets, that there's protection being taken in gold. And I've talked about this at length in the past. And the whole discussion around gold is that this is going to be your best bet as we form the top. I talked about it in equities earlier in the show, is that you're going to see this thing. This gold is going to be the alternative bet. And I keep telling you guys, look at GLD or if you do have futures capabilities and you just want to play into the futures. But the bottom line is we're going to see gold start to move higher in this pattern. And as we go in and look at the intermediate graph, we're going to see nothing wants to work right today. Here we go. Okay. What we want to see here as we go intermediate, look at the weekly gold, you'll see here on the chart, is that it is also setting a pattern. Interesting enough, the 40-week moving average and the 200-week moving averages are right at that 1275 level. Very similar pricing. There's another cluster that's occurring in this market on the inverse than like the equities where they're coming up. So we're going to test these levels. Chances are we'll get through it. And as I bring up the long-term graph here, then what we're going to see here is really pretty significant from the standpoint that this is going to move up above the averages here, which are 1294, 1285. So I talked about this at length a few weeks ago, is that once we break over 1300, then the next run is going to be to 1400 to 1600 level. And I think ultimately this chart ends up getting well into 1800, even rendering an all-time new high on gold. And that only goes step in step with what I've been talking about from the standpoint when I did the special. Like I said, if you haven't seen the special show, go on the channel, and it's I believe it's 26 minutes and change. Watch that on the equities. Well, I think this is one of the hedges you want to have on for equities. You can do inverses and all that type of stuff with the equities, but this is a nice, clean alternative bet that you can put on that's going to going to work, and certainly from an advisor viewpoint, this is going to look good from positioning some type of alternative asset in your mix that you have out there. So this is going to be, I still am very convinced that this is going to be one of the bigger trades out there. And, I'm still, I've actually got positions on that was put on, in the 1160s, 1180s that I'm holding on a personal level. So I think, I get my money where my mouth is, but it's a really good bet. It's working a little bit, but the big trade is not until 2019. And if you go back and you look at, I think I have this chart here, I'll go back over here. But if you look at this graph here, then bear with me one second. I'll get to the right one yet. This is it here. If you get to this chart here, and what you're going to see is as we go through these zones, and like I said, this configuration isn't how it's going to set up, but we're going to see the equity markets stair step down. Next 2-3 years, it's going to be absolutely brutal. There will be tradable rallies on the upside, but the buy and hold guys are just you're going to really get hurt trying to do a 60-40 strategy. I still think rates, in spite of the backup that we've seen recently back to 3%, they're still going to move to 360, 380 sometime next year. The forces are all in play, and I don't think the Fed isn't going to necessarily be pushing them there. I think there's going to be other issues, and I talked about in the special report I did last Wednesday, is that this is really related to the debt issues that are starting to come up. We got $9 trillion worth of corporate debt. We've got $22 trillion almost in the U.S. debt, and the amount of money is going to have to be raised in the next couple of years is going to finally put some pressure on it. So it's going to be very difficult, like a 60-40 type strategy is going to be under a lot of pressure. So let's finish the show here and talk about, go back to the equity markets here and just take a look at what's likely to unfold for the balance of the week. Like I said, we've got the disruption for the funeral for President Bush, but the bottom line is this pattern that we're looking at here on this chart is setting up to be just what's called a double three, a zigzag, where you get an ABC. You got ABC. This is let me just draw it in. We'll finish here. And I talked. Like I said, if you're not a subscriber, please make sure you subscribe so that you know when I kind of come up randomly during the week and cover this stuff. This week is, like I said, it's going to be chopped up. So we'll see what kind of movement we get right now. But as we look at this pattern here, this is exactly what's likely to happen. And I need to do one thing just so I can bring this up a little bit more. Bear with me 1 second. I just want to move this over so I can draw on this a little better. And we'll finish the show here. So this pattern here, this is what we've done so far. We've done, this is A, B, this is C, and we're going to get an X wave down. We're going to get another A, B, C, and then that next pattern should be down. How contracted this pattern is going to be, I don't know. Like I said, I expect that we will stay sideways through the month of December. I don't think we get above 28.16, 28.28. We were at 2800.18 today, and there were plenty of sellers up there. And there's still folks looking to lean on this thing should it try to rally back. I don't think we'll see a sharp rally into the close. But the bottom line is this pattern that I have on the screen is most likely going to be what sets up. And so that what it does, it sets up huge opportunities. Like last night when I was tweeting to sell 2807, you could have sold the open this morning. I actually did the NASDAQ triple short on the open this morning. Already covered that. But there's a lot of little scalp trades that you can do intraday, and there's going to be multiple. For instance, there's probably going to be 5 to 8 days on the downside. Once we get through today, chances are we've also got a gap here I didn't talk about earlier. The gap needs to be filled. And let me just take this off. I'll tell you where that number is. I'm sure I will discuss that in commentary tonight. But that number is, one second. That number is Friday's high was 27.60, and the low so far today has been 27.73. So we've got about a 13-point gap. That most likely get filled in the next couple of days. Maybe there'll be another rebound attempt at 2800, but it's most likely going to fade. So as we go through this week, expect this sideways. I would expect that today is probably the high of the week. Very likely that we're seeing the high of the week right now, and we'll fade this thing back after a big 4.9% gain last week. We're just in logical viewpoint of the market to tell you we'll probably back up and maybe a couple percent by the end of the week. So we'll see how it all plays out. As always, thanks for watching. Make sure you subscribe so when I come up and do these random shows that I do, and sometimes I'll go into my WaveTech scalper trades and other things that I do professionally and for myself. Anyway, thanks for watching. We'll see you on this show next week at the same time.